What if you could legally eliminate taxes on millions of dollars of investment gains forever? Welcome back to another episode of the Vital Wealth Strategies podcast. I'm your host, Patrick Lonergan. And if you're an entrepreneur who's tired of writing massive checks to the IRS, this episode might just change the way you think about building and protecting your wealth. Today, I'm sitting down with Michael Malloy, one of the leading experts on private placement life insurance, or PPLI. For more than 30 years, Michael has helped ultra-wealthy families across the globe protect their assets, eliminate taxes, and pass on generational wealth using a strategy most financial advisors aren't even aware of. In this conversation, we unpack what PPLI actually is and how it's different from the typical life insurance policies you've probably heard about. We talk about who the strategy is really designed for and how crypto investors, real estate owners, and business founders are using it to create tax-free dynasties. And we break down why this structure gives you the flexibility to invest in almost anything while keeping it off the radar of the IRS. Michael also shares what kind of team you need to build this structure, how it fits into your overall wealth plan, and a real-life case study that shows what happens when the strategy is done right and what happens when it's not. So if you're building a business, growing your wealth, and looking for smart ways to protect what you've built from taxes, lawsuits, or even divorce, make sure to listen all the way through. And if this conversation sparks some ideas or questions about your own tax strategy, head over to vitalstrategies.com/tax. You'll find our latest resources, planning tools, and advanced strategies to help you keep more of what you earn. All right, let's dive in. Welcome, everybody. Today, I'm pleased to introduce you to Michael Malloy. Michael has served the financial needs of wealthy families worldwide for over 30 years and specializes in private placement life insurance asset structures. And he's been doing that for 20 years. He's literally written the book on private placement life insurance. So we are excited to have him here today because it fits well with our conversations with our clients on really minimizing taxes, mastering wealth, and optimizing our lives. So, Michael, thank you so much for joining us here today.
Well, thank you very much for having me.
Yeah, I'm excited about this conversation because oftentimes we find that our clients are they've grown successful businesses, they've acquired assets, and we look at all of the different ways they get taxed, and it's awfully frustrating. And one of those tools that we look at as an effective tool is life insurance. And oftentimes we're familiar with a life insurance policy that maybe has some cash value, and I have to pay the premiums in, and it could have some different investment components. You know, I think the examples we're familiar with are maybe whole life, then universal life, and then there's some indexed universal life and variable universal life. There's different flavors of that. And I'm excited to look at how private placement life insurance can be an alternative to some of those and who it really works well for. So yeah, can you just give us a little bit of your background, how you got started in this industry, and then we'll really dig into the topic.
Well, I started out as a risk management consultant, and that morphed into running a small private insurance agency for a Bay Area, a San Francisco area firm. And then I have a kind of a funny story that one of the companies said, well, you know, if you're going to continue with us, you have to sell life insurance. And I said, oh, no, I don't want to sell life insurance. You know, I like the property and casualty, you know, businesses, homes, etc. So finally, I got a call one day. It says, well, you better, we're going to cancel you. So I went out, and my first client was a chain sawyer. And he was the kind of a guy who they helicopter in to a forest. And then, not just him, but multiple guys. And then they cut down the trees and helicopter the trees out.
Wow.
And I thought, and he had 6 children. So then I thought, well, he seems a good candidate, but what company is going to take him? So I filled out the application and I sent it in, and it passed through. So I called the company, and I said, I was a little surprised that you approved this. And they said, we don't underwrite for profession. So I thought, well, I scored pretty well on my first case.
Yeah, I love it. Yeah.
So that kind of morphed into more sophisticated, life insurance strategies with estate planning attorneys. And then kind of in the early 2000s, I kind of went more international.
Yeah, very good. I think when about the issues that our clients are facing, and they're losing too much money to the tax, right? They're paying, you know, property tax, payroll tax, income tax. Then we get capital gains tax on the money that we've already earned to pay tax on, and then then there's estate tax at the end of our lives. So we're getting taxed again on all of those things. And so I think that's awfully frustrating. You're clearly an authority in this space. Can you give us a quick overview of how private placement life insurance works, and then we'll start digging into some of the details there.
Yes, it at first to blush, as you said, it seems like a strange vehicle because most people,
Mhm.
I like to say, they kind of lump all the insurance in their brain, and after a certain age, they begin to hate insurance because, they've had a bad auto claim or whatever. But
Mhm.
so on the retail level, it's true. Life insurance doesn't really solve your client's financial problems, but
Mhm.
private placement life insurance does. So can I give you just a very brief history of?
Yeah, that would be wonderful.
Okay, so it actually started in the 1970s, and executives of Fortune 500 companies wanted a broader investment platform to invest in. And that by the 1990s, very wealthy families and estate planning attorneys said, well, we can use this for our own planning. And then in the early 2000s, major companies came into play. So you might ask yourself, well, it's been around since the 1970s. Why haven't I heard about it? Why, if you're saying this thing is so good for me? Well,
Mhm.
there's basically two reasons. The IRS has very specific rules about who can invest in a private placement asset structure. To summarize the rules, for the most part, you need to have $5 million or more to invest. And then the other reason is what has to come into play to get a structure started. It involves tax planning, financial planning, insurance planning, estate planning. So for the most part, people are happy to stay in their lane. They don't go too far afield. So that's why very on in an engagement with a client early on, we start to put together a team of experts who can help them
Hmm.
bring the structure into fruition. And what we usually end up with is a mixture of their trusted long-term advisors and the various specialists that we bring into the picture.
I love it. So this is oftentimes a similar role to what we play. We feel like we're involved in the client's four cornerstones of, I'll call it the what we dub the entrepreneur private office, and it starts with cash flow. Let's understand the client's cash flow really well. Then let's understand and attack the tax liability. Let's drive that number as low as we can possibly get it. Then once we're not sending money to the taxing authorities, let's invest the dollars that we do have. And then finally, let's build a protection piece around all of it to make sure that the wealth we've built doesn't go away. And as clients' wealth grows, their complexity grows. And so we are very broad in our understanding. We know a lot about, we know a little bit about a lot of topics. And so we have to go bring in the experts and go, oh, this is a perfect opportunity to put a trust in place, or here's a legal structure that we could utilize, or we need this third party administrator to execute on this tax strategy. And so I think it's great that you're helping build the team. Can you talk us through what that team looks like? Who's involved in that team to really start to build out this private placement life insurance structure?
We do the insurance planning, of course,
Hmm.
and
Sure.
the it kind of depends on the structure. A typical for a U.S. client, a typical structure is a life insurance trust. So almost any estate planning attorneys can draft a life insurance
Yeah.
trust, but we have to bring in one who knows how to make it optimize it for private placement life insurance. Um, so knowing who to go to. And then there's
Mhm.
some that have various subspecialties. We do a lot of crypto clients. So
Mhm.
if so, we have some estate planning attorneys who really know crypto, and then
Yeah.
um, say for a real estate client, uh, then we bring in an estate planning attorney who knows real estate.
Sure.
Um, but we try to disrupt as few relationships as possible, and the
Yeah.
attorneys that we do engage, they're very good at working with the clients. Long time
Mhm.
advisors. We're not trying to kick people
Yeah.
out of the picture.
Sure. I fully understand that. We think the same way. It's like we're not trying to replace anybody's CPA. Oftentimes attorneys are different than the CPA because the CPA you need them every year. Oftentimes attorneys have a specialty, and I call them up when I need them for my specific problem, and then when I don't need them, I can go sort of put them back on the shelf and then grab another one when I have a different problem. And so that's really good. So I want to go back to something you said. Typically, it's $5 million to invest. Now, going back to the fact that you've got clients putting crypto and real estate in, that doesn't need to be 5 million liquid cash, right? It could be 5 million of assets that I'm already holding. Is that correct?
That's great. Getting them into the policy uh, it involves some more legal issues. Say, just go to real estate. If somebody has extremely low basis real estate, what we usually would do is like a sale for a note, not the IRS bloom payment one, which they've come
Mhm.
down upon in the last couple of years, but one where they pay a reasonable amount of tax over the, a reasonable amount of time
Sure.
to soften that blow. Otherwise, it's either, depending on the structure, the IRS considers it a sale or a gift. And
Mhm.
we do our best to avoid that. But then once it's in the policy, it avoids all tax. It's like all life insurance policies. Uh, what's in there gets tax deferred growth, and that's since the beginning of cash value life insurance.
Yeah, no, this is great. Now, I know there's been some rules that it used to be I could have a very small face amount and I could max fund a life insurance policy. And then the government came out and said, well, this is we gave this tax free nature because we liked the I'll say the community social impact of the death benefit. Now it seems like it's more of a tax move, and so they put the modified endowment contract rules in place to help us sort of keep life insurance at the forefront. Do the modified endowment contract rules apply in this scenario, or does that not really come into play?
Yeah, very much. They very much come into play. There's kind of two very basic uh, policy designs. So for a younger person, they use these structures much like a retirement account. It's
Hmm.
kind of you might call it an unlimited Roth IRA, without
Yeah,
the Roth rules. Um, and for older clients, the whole strategy is leaning toward being part of their estate plan.
mm,
Uh, so each structure has certain rules, but we mostly avoid the modified endowment rules with either of those two structures.
sure. Okay, this is great. So when I'm thinking about a traditional life insurance policy, that insurance company is insuring, they're utilizing the law of large numbers, right? They've got lots of people that they're insuring, and they know some people are going to live to life expectancy, some are going to be longer, some are going to be shorter, but they know that how the death benefit's going to pay out. Can you talk to us how death benefit works for a private placement life insurance policy?
Well, for the most part, as we talked about, we're using the tax benefits of life insurance
Hmm.
uh, to increase the amount of their investments over the course of their life. So
Sure.
we try to keep the death benefit as small as possible. So
Right.
on some designs, it can be as little as, say, 5% of what's the total asset value in the policy. But in general, that fits the client's needs. It's not. It's kind of the opposite strategy of when, like an estate planning attorney tells a client, "Well, you need your estate planning bill is going to be $10 million, so you go out and buy the cheapest term insurance that you can, that's going to run the course of your life to satisfy that." So in general, uh, ours combines, their investment growth with the low death benefit. So if you compare those two strategies, generally they're going to pay much more for that 10 million in term than they are for this, say, 5% over their asset value.
Got it. Okay, great. We love the concept of the tax-free wrapper of life insurance, and so I was just trying to understand, how we go about calculating and paying out a death benefit to still meet those, we'll call them requirements to have some death benefit in the mix. So that's great. So can we talk a little bit about the mechanics of how? Let's use the crypto example we were talking about. Somebody's got a huge crypto portfolio. They've got other assets, and they're like, they call you up and say, "Michael, I want to move $5 million of my crypto portfolio into private placement life insurance." What is their flexibility for changing that investment once it's in the life insurance? Can they call us up and go, "Hey, Michael, it's time to make a change. I think crypto's been great. It's run its course, but now the new opportunity is this business venture that's wandering into AI, and I want to move my assets over there." Is there opportunity to make changes on the investment side?
In fact, it's ideal because the PPLI asset structure is classified as a variable life insurance policy. So the tax code says within the policy you can make tax-free exchanges. So within the policy, you can diversify into almost any asset class.
I love it. Okay. Just thinking about going back to our crypto example, let's say I made an initial investment of $500,000, and now my portfolio has grown to $5 million. Can't the tax consequence of moving those assets into private placement life insurance? I think my main question there is, do I have to pay tax when I move it into the policy?
Again, it depends on your basis. So, but in general, if you're thinking about, long-term or semi-long-term, 5, 10, 15 years, we can do the sale for the note, even if it's a very low basis, and you might have to pay, some tax. But it's almost always better to pay that tax now and then reap all the future gain inside the policy than to worry about paying that tax now. Because once it's in there, if it's structured properly, there's no tax. And then when you pass away, it all passes to your heirs as a tax-free death benefit. So the only, time we've really had clients balk is like this example of the real low basis real estate. They, and inherited some commercial property from their grandfather, and the basis was so big, it's not worth putting it into the policy, and the tax bill would be too high.
Got it. Okay, great. Yeah, no, this is fantastic, because I think about where we're at in the U.S. right now. We've printed trillions of dollars. The debt is growing dramatically. I'm thinking about how we're going to pay for that. There's some talk on utilizing tariffs and some of those other things. But I think at the end of the day, if we think about our household, I can't be running at a deficit for too long, right? And the U.S. has been running at a deficit for a long, long period of time, and it's just not sustainable long term. And so I'm concerned that at some point, we might be at a historic low for income tax rates. And like you're talking about, it would be ideal to pay a little bit of tax now to move as many assets as I can into a vehicle that allows me to um, grow those assets tax free forever, right? Especially utilizing something like a irrevocable life insurance trust that those assets pass on tax free and aren't a part of my taxable estate. I think is fantastic because the estate tax keeps growing. I think that'll probably extend with the Trump administration, but at some point, if we look at the history of the estate tax, we've seen it all over the place, and a lot of our clients are looking at, $100, $200 million net worths, and they're still in their 40s, right? And so, their trajectory is, they'll probably be at $1 billion by the time they pass away, and it's, they're going to well outpace the estate tax exemption. So, I think this is great. So, can we talk about a lot of our clients are business owners? Is there opportunity to hold some of the shares of the operating company in private placement life insurance? Because I look at how quickly some of these businesses are growing, and I'm like, wow, that could be a tremendous tool if that's something we could do.
You can, but you have to be very careful. So this is where the attorneys that we bring in really earn their money, because there's something called the investor control doctrine. So what it basically says, and to summarize a stack full of legal documents, inside the policy, like you said earlier, when the IRS gives a tax benefit, they also take something. So in this case, they're taking some control from you. They said, well, you can put all these assets in the policy and they can grow tax deferred. That's fine. That's perfectly legal. But you can't micromanage them. You can't tell your investment advisor that you have to put in place when the assets go into the policy. I want to buy Apple stock when it's at such and such, or I want this specific bond. You can give an investment mandate, and that mandate can be very broad. I mean, it's very similar if you go to J.P. Morgan, Chase, or Mellon and give them your portfolio. The investment advisor is going to work with you at your risk tolerance level, but they're going to, do the daily nitty gritty of choosing what stocks and what bonds. Otherwise, you wouldn't go to them. You'd just do it yourself.
Right.
So you have to give up some control, but the person you can appoint as your investment manager, it can be somebody of like mind. I mean, there's no rules about choosing any kind of buddy with reasonable qualifications. So for most people, they're willing to give up a certain amount of control for that, tax deferred growth.
Yeah, I love it. So I'm thinking through the real estate example. Let's say I put my I buy a piece of real estate. I buy a piece of real estate. I don't have it. 5 years down the road, we've managed that property. We forced a fair amount of appreciation, and now that we want to sell that project, do I have control over when I sell it?
Kind of yes and no. The very phrase says it's vagueness, the investor control doctrine. So what it comes down to is, a half dozen private letter rulings and a few cases in case law, but there's no written, it's not etched in stone. about what you can do and can't do. Like I said, you're not supposed to, have complete control, but you can have some control. So it's kind of a facts and circumstances case. But if if your investment mandate to the investment advisor is that when the property value reaches a certain place, a certain gain that's you want to sell, then that's perfectly fine. But you're not supposed to call them up in a panic and and say the tea leaves said I'm supposed to sell today, so please sell it.
Yeah.
It,
Yeah, no, that's great. One of the things, and I'm wondering if this would check that box. Oftentimes with our clients, we're creating an investment policy statement, and in that investment policy statement, it's saying, with a sober mind, here's the decisions we would like to make with our investments. And would it be the case that you would have something like that in place? And so, it's going to take some of those. When the markets are doing, what markets do, and clients start to get concerned, they're not calling you up going, "Hey, now's the time to sell or to buy." And we're like, "Well, hey, hold on a second. Let's just look at what we agreed to, how we were going to manage this with solid investment principles, and let that dictate our decision making."
Yes. I mean, that's an
applicable?
excellent example of something that I think most practitioners would say it does not run afoul of the investor control doctrine.
Okay. Yeah, that's great. So, Michael, when somebody puts their assets into the private placement life insurance, are they having their investment manager make some of those decisions, or is that somebody from is that you or your team that's helping pull the levers on how those dollars are invested?
Yeah, our team and the insurance company are investment agnostic. Like, it's totally up to the client and their investment manager.
Got it. That's great. So when you bring in the life insurance company component, can you explain how the life insurance company fits into private placement life insurance?
Well, for us, we deal exclusively with offshore companies because the client gets much superior asset protection. They get a broader range of investment structures. There's the costs are lower. So the insurance companies we work with, for the most part, the clients never heard of them, but they act more like administrators of all the assets in the policy than they do like a traditional life insurance company. But the death benefit then is handled by the largest reinsurers in the world, like Munich Re, Swiss Re, Arch, who in some cases have trillions of dollars under management. So your death benefit is completely secured by these gigantic reinsurance companies, and for the most part, the client will find out over time it's much better to deal with a kind of a small, office of people who really know the PPLI than some large bureaucracy that you would find at a traditional life insurance company.
Yes. Speaking from experience, we've got clients that have significant dollars tied up in, and I say that in a good way, in a life insurance policy. But sometimes when we, our contacts at the life insurance policy, we're not getting the kind of service and follow through that we would like, because like you mentioned, it's a huge bureaucracy. We're calling in, we might get somebody in a call center that may or not be familiar with the workings and how all those things shake out. So I think that's fantastic.
Hey, real quick, if you're listening to this and thinking this is the kind of strategy I need in my life, I want to invite you to check out vitalstrategies.com/tax. That's where we can collaborate on advanced planning ideas, tools, and resources to help entrepreneurs like you keep more of what you earn. Whether you're already working with a great team or just starting to explore tax saving strategies, you'll find insights there that can move the needle in a big way. Again, that's vitalstrategies.com/tax. Go check it out when you've got a minute. Now let's get back to the episode.
One thing that we often look at too is when we think about our levels of tax planning. Okay, level one is the IRS gives us guidance, but it doesn't take any investment. So this is good administration and bookkeeping. Level two is the IRS gives us guidance, but we have to invest some dollars. Now this is going to be like IRAs, 401ks. Those are typically very, very low cost to administer. Level three is we're combining sections of the code to create efficiency, and we have to bring in third-party administrators to help us execute on these plans. And there's usually minimum amounts because the fees start to, you have to pay professionals to execute on these things. And the fees start to, erode the benefit if we're not putting enough dollars into the plan. What would you say is a sort of a minimum threshold? Before we started, about $20 million in net worth would make sense for a minimum client net worth to start looking at private placement life insurance. But what's a minimum dollar amount or value that should go into a private placement policy?
Probably 5 million.
Okay. And then typically, what does the fee structure look like to put something like this in place? Is it a flat fee? Is it depend on the professionals we're bringing into the mix? We've talked about, we might have to bring in a real estate attorney or an attorney that understands crypto better. How much of that is variable and how much is fixed?
Typically, on the insurance company side, there's a 1% setup fee. 1% of the assets going in because most all the work goes on at the beginning, and then there's a 1% ongoing M&E for like somebody in the 10, 20, 30 million range, and then when you start going up to say 100 million, that 1% annual fee starts scaling down to maybe 50 basis points. So it's a very small fraction of what one would pay on a traditional life insurance policy. And for the most part, particularly say on a whole life policy, you can't even figure out what you're paying in fees, but you can see it in the commission in that in the first few years, you hardly have any cash value. So where is that going? The clients, one thing they like about, the first time I was shown an illustration, I couldn't quite believe it. It was just like 8 columns on an Excel spreadsheet, and every penny is accounted for. So clients like the transparency of PPLI.
Yeah. Beautiful. I think the next question I have is, can we talk about the underwriting? If somebody's in great health or terrible health, how does that affect private placement life insurance?
It's much more flexible in that anyone who has an insurable interest in the structure can be the insured life, or you can also have multiple lives. So if someone, and then the other flexibility is when do you want the death benefit to be paid out? We have some structures where it's virtually never paid out because we keep switching in an insured life. If somebody's, starts in their 30s and 40s, and maybe by the time they're in their 50s, they're diagnosed with something that's going to lessen their life expectancy, we can switch an insured life. And then sometimes you do want the assets to pass for estate planning reasons. So it's fine to have the death benefit payout. So there's much more flexibility than traditional life insurance.
Yeah, that's fantastic. So I'm going to summarize some of the things that we've talked about here today, and then I've got a few follow-up questions that we'll build on that. So typically, some minimums are about a $20 million net worth and committing about $5 million to the private placement life insurance. The fee structure is very low. There's lots of flexibility with underwriting and even replacing insureds. And we've seen that with some traditional policies that are maybe corporate owned, and an executive comes in and then we can, they leave and we can replace, that executive with the new executive. And so that all makes sense to me. And we can fund this with non-cash assets, which I think is fantastic. And again, I'm looking at all these things and I'm going, Michael, this sounds almost too good to be true. I'm taking my assets that are taxed in a capital gains, income tax, and I'm moving them into an investment tool that sort of eliminates a lot of that tax. Can we talk through how closely the IRS looks at this, and does this open me up to some additional scrutiny? And we'll just pause there before any additional questions. But yes, how does the IRS look at these private placement life insurance plans?
Well, I'll kind of answer it in two parts. The first is they hardly look at them because the reporting is so minimal. For the most part, they can't even figure out if you have one. That being said, in the Biden administration, the head of the Senate Finance Committee, Mr. Wyden, shined a very bright light on these structures. But now with the new administration, the new head of the Finance Committee says they're fine, and we're not going to be shining a bright light on them. So I see it as great advertising if the former administration is so concerned about the tax savings on these plans. Doesn't that say something about the plans? If the current administration hadn't come into office, I probably would be answering your question differently. I'd be saying you should probably be pretty cautious about them and so on and so forth. But they'll probably still exist for a certain number of years because Congress has a hard time deciding on even when to meet, let alone a complicated tax decision and changing the regs of not only the tax code but the insurance code to make these plans unpalatable. So
sure. And I'm curious your perspective, and I know you don't know the minds of Congress, but when we look back in time and they made changes to life insurance, they drew a line and said anybody with a policy before this line, you get to participate with the old rules. Anybody that's putting a policy in place under the new rules, like this is how you have to structure things.
yes,
Would you see it the case?
Yeah, that's the traditional way. Yes.
So if they did change the rules, if we got our policy put in place before the rule change, we're probably in a fairly healthy place. And then they would just draw a line and say, well, this is what your private placement life insurance needs to look like, or private placement life insurance is no longer, acceptable. Because I think there's a concern of, what I don't want to have happen is I put this strategy in place and then all of a sudden, Congress decides to retroactively rewind, and unwind 5 years of good work. And it's like, that's pretty challenging. We don't have too many examples of that. They've tried to do a few things retroactively with, a few months, but they haven't necessarily gone back years. So,
well, it's pretty complicated if you're going to do it that way to figure out, it gets very messy in terms of the enforcement. Traditionally, what they usually do is they grandfather all existing plans and say, from January 1st on, you better do it the new way.
Yeah, very good. Michael, if it's not too much trouble, can you give us an example or a case study of how you've seen private placement life insurance work out well for an entrepreneur in their financial situation?
Yes, I have a client in mind, but it has a kind of a unhappy ending. But the unhappy ending, I think, can serve as some. I think it will be useful for our audience to hear. So the person I'm thinking of was a crypto investor. So he had about $30 million of crypto assets that he wanted to shield from tax. And let's give him a name that's not his own. Let's call him Tom.
Mm-hmm.
So Tom was an engineer, and engineers can be challenging clients because they want things spelled out, they want things in writing, they want things very clear. So we were happy to have him because that's the way we do things. He was even able to help us out because it's not complicated to put in place these structures, but there is, like, say, a dozen steps that you have to go through. So we typically give a client this list of steps at the beginning. So Tom, in his attention to detail, was able to help us out here and refining our steps. So his structuring is pretty simple. Created a life insurance trust, and that purchases a policy, and the assets go in. The basis was reasonable. He had to pay a small amount of capital gains tax, so he was very happy with the structure. But unfortunately, a few years after he had it in place, his marriage of many years began to fall apart. So one of the asset protection elements that we fold into the structure is, we call it divorce proofing. Normally, a contesting spouse would have no access to any of the assets inside. But Tom, early on, thought, well, he can make this divorce kind of go away, he thought, by dismantling his structure and dividing it in two and giving it to his ex. So we thought, well, that's a smart thing to do. But then it turned out to be kind of the opposite, because she became very aggressive and wanted even more, which brings up another element of the structures. A lot of tax saving structures are very difficult and costly to unwind. But a private placement life insurance it costs next to nothing, or sometimes nothing, to unwind. So clients like that. And like I said, in Tom's situation, he kind of made the wrong move. But if he made the right move, he could have protected all those assets in his divorce settlement.
Yeah, got it. No, that's fantastic. Because when I think about what private placement life insurance offers, there's it sounds like anonymity, which is great. There's a tax shield. We also have fairly simple compliance, it sounds like. I don't need to have a full team of legal and CPA staff to manage this thing every year. Obviously, there's going to be some pieces, I'm sure, of the life insurance trust that take some of that. But it just seems like it's checking a lot of the boxes for us when we're thinking about one of the things that we outlined at the beginning, that the four cornerstones, right? It clearly has a tax piece, it has a wealth building piece in the investment side, and then it has an asset protection piece that's also fantastic. So love all of those pieces, and then not terribly expensive to administer, which I think is also fantastic. Sometimes we're weighing the cost to administer compared to the tax, and if we're looking at 1%, it's a pretty low cost to put this structure in place and keep it going. So this is fantastic. Michael, is there anything else we should be talking about with private placement life insurance that we haven't touched on yet?
Well, you just mentioned one, simplified reporting. Sometimes clients are tearing their hair out of, particularly with the K1s, at tax time. Well, you don't have those once the assets go into the policy. So basically what you're reporting to the IRS is that you have an insurance policy, and you report one number, the total cash value. So that's your reporting obligation. So that's why I said earlier that the IRS hasn't really looked at this because it's not really apparent from a normal return that you have an offshore PPLI policy with, because you're just reporting that you have an insurance policy and you're reporting just one number.
Hmm. Sure. Yeah, that's great. I guess thinking through all of the benefits, why wouldn't somebody do PPLI, private placement life insurance? What are the downsides to considering this strategy?
Well, if somebody, we hit on it earlier when we were talking about the investor control doctrine, if somebody is such a hands-on person, they don't want to give up any control.
Yep.
They're going to run afoul, like this
Yeah.
famous case with Mr. Weber, who I don't know, there was like thousands and thousands of email communications with the client and his attorney and other advisors about what he wanted to do and not do in the investment. So if you're of that ilk, it's probably not for you. And in general, you know, because in some sense, when people hear the word life insurance, like I said earlier, they lump it
Mhm.
together with, all their other uh, insurances and experiences with insurance. So they're a little wary that uh, something called life insurance can do all those things.
Yeah.
So I would say uh, those are the main reasons. And like
Yeah.
and then the other one, like I said, with the uh, even though the client doesn't have to be an expert in all the disciplines that have to come together to put the structure in place, uh, they have to have some understanding. So it takes a somewhat sophisticated client. I mean, sometimes you just scratch your head, but I mean, in the crypto world, there's a lot of 20-somethings, millionaires out there.
Mhm.
So, I mean, that we had one who, I think he was like 25, and uh, it was like kind of the biggest home run you can do, and with
Yeah.
a tax structure. It was kind of like a pre-IPO situation.
Hmm.
So, yeah, it was his, we'll call it stock, the equivalent in crypto, uh,
Hmm.
was worth almost nothing. And then he thought it was going to go to, you know, over 100 million. But we said, well, and that was going to happen in 6 months. So,
Hmm.
so, but to put that in place, he had to pay like, I don't know, 150,000 for a fee, to the
Yep.
company to set this all up, the attorneys and all that. And he didn't want to pay.
Yeah.
So he would have had like, instant tax-free growth over $100 million. And we couldn't convince him that it was better to pay a little money now, but in his world, like, he's barely learning about tax. He hasn't had many
Yeah.
tax bills, so, uh, that was a very frustrating session.
Yeah. 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 And it's interesting because we've had clients that fall into that category too. And some ex-clients that they've had a lot of success in a very short period of time and they haven't gone through the ups and downs of entrepreneurship yet. It's all been up. And, we try to give them wise counsel on, hey, here's how to protect some of these things. Here's how to, and they almost think they're, bulletproof, like that none of those things are going to happen to them. And so we just figure out real quickly that those engagements don't make a lot of sense for us long term. But because and it could even be so much as like, they want to continue to pull the levers, make the moves on the investment side. And I could see that being a scenario too, where it's like, that's not how this is going to work now. This life insurance policy with $100 million in it will take care of you for the rest of your life, but you can't call us up with your new hot stock tip. So yeah, that's great. Um, Good. So, Michael, is there anything else we should be talking about before we wrap up? Because I've got a few things on the wrap up side, but I don't want to miss any key points.
No, we talked about the asset protection, the divorce proofing, The simplified reporting. By far, the biggest reasons people come to us is the tax deferral. And so,
yeah. Yeah, no, and I think I agree with you. Oftentimes people hear life insurance and their brain shut off. They're like, I don't want anything to do with life insurance. And what I want to do is go, no, let's embrace life insurance just as a tax wrapper. Let's just think of it as what it can do for us from a tax efficiency perspective. Let's look at it on its merits, and then we can decide if we like that as a tool or not. So I think that's great. So thinking about call to action, I think if we've got clients that I think this absolutely makes sense for. We're going to have to set up some time to talk more about this opportunity and how we can get them plugged in. Because when I think about the buckets that are available to us from an investment perspective, I've got, we'll call it a qualified retirement bucket, right? Pre-tax bucket. Every dollar I pull out is 100% taxable. It's probably my least favorite bucket. It's okay. It moves dollars down the road, but I don't like taking money out of it. Then I've got the sum tax bucket, which is like my brokerage account where I'm going to pay capital gains, and my real estate falls into the sum tax bucket too. And then I've got the no tax bucket, which are tools like life insurance and Roth IRA and that type of thing. And it's like, I want as many dollars as I can get into the no tax bucket. That's by far my favorite. So I think the work you're doing here is fantastic. If people want to reach out to you and get connected and talk about, private placement life insurance, they can call us and we'd be happy to get them plugged into you. But is there a place people should go to learn more about private placement life insurance?
Yeah, our website, ewp-financial.com, has an abundance of material, videos and different pieces I've written over the years. So there's lots there.
Fantastic. We'll make sure we have notes to that or links to that in the show notes so people can go check out ewp-financial.com. I appreciate all of the information and knowledge that you've shared with us and put out there on the web. I think this is an unbelievable tool that, like a lot of the things that we talk about with our clients, they don't get a lot of press because they're not for everybody, right? Like there's not too many people that are wandering around that have $20 million net worths that are looking for this type of strategy. And so we feel like it's our job to bring these things to the public's attention and start looking for opportunities to pay less tax. If we felt like the government was effectively using our dollars, I think we might be okay with it. But if you don't pay the IRS, you don't pay the government, you don't pay the taxing authorities the tax that they tell you to do, they start to take your property, and I don't like that. So let's do it compliantly. Let's pay the least amount of tax possible. And I think private placement life insurance is a fantastic tool to help build this tax-free asset that has tremendous long-term value. So, Michael, the work you're doing here is great. You can really help transform an entrepreneur that's frustrated by the tax to somebody that feels free of having to send huge checks to the IRS. So keep up the good work. Thank you.
Well, thank you.
Thanks so much for tuning into this episode of the Vital Wealth Strategies podcast. I hope you found real value in this conversation and that it gave you some new ways to think about building and protecting your wealth. If this episode sparked any ideas for you, or if you know someone who could benefit from learning about private placement life insurance, do me a favor and share it with them. These are the kinds of strategies that don't always make headlines, but they can be absolute game changers for the right person. And if you're ready to dive deeper into tax strategies that help you keep more of what you earn, be sure to visit vitalstrategies.com/tax. You'll find tools, insights, and high-level planning ideas to take your wealth strategy to the next level. Don't forget to come back next week. We've got more powerful conversations lined up to help you stay ahead, think bigger, and grow smarter. And remember, you're a vital entrepreneur. You're vital because you're the backbone of our economy, creating opportunities, driving growth, and making an impact. You're vital to your family, creating abundance in every aspect of your life. And you're vital to me because you're committed to growing your wealth, leading with purpose, and creating something truly great. Thank you for being a part of this incredible community of vital entrepreneurs. I appreciate you, and I look forward to having you back here next time on the Vital Wealth Strategies podcast, where we help entrepreneurs minimize their taxes, master wealth, and optimize their lives.